Good evening, everybody, and thank you so much for joining us on a slightly shorter notice. My name is Amar Shah, and on today's call on largely fixed income, I have S. Naren, CIO, ICICI Prudential, and Manish Bantia, Deputy CIO for our fixed income. Uh, Before I hand over the call to Naren, I just wanted to take this opportunity once again to thank each one of you. We are at a very interesting times globally as well as domestically. And when we look at every asset class across the globe as well as in India, we are witnessing the volatility uh, as far as markets and asset classes are concerned. However, today's call is all about fixed income. Fixed income to us from the Indian context is one of the largest asset class when we look at the corporate India as well as the household and the investments that we have into fixed income through various forms, whether that's in the form of a deposit or a bond or PPF or fixed income mutual fund. As a category, it's one of the largest holding. And it is something which cannot be ignored. It is something which has to be part of the portfolio. It's something which, at the current environment where we have seen rates moving up significantly over last 1 year, we have been getting a lot of questions, a lot of queries in terms of our outlook, in terms of our view, and how do we fit, how do we ride this asset class, how do we go about investing into this asset class. So we thought that we'll take this opportunity and focus a lot or focus this call largely on that asset class. However, I'm very sure that everyone also wants to know that what's the larger outlook on equity as an asset class. So without taking much time, I would want to invite Naren to share his view on asset class, on macro, on global, on Indian markets, as well as on fixed income. And also Manish, after that, to share his view on the fixed income, especially now that we have a policy which has just recently gone behind us with a rate hike. So on that note, over to you, Naren.
Welcome to all of you. It's a pleasure talking to all of you today. Uh, 2022 was one of the most interesting years in the markets, particularly globally. But thanks to the very good work done by Indian investors, what happened is FIS sold, but look, domestic investors bought. The markets did not fall in India because even though FIS sold, the domestic investors buying resulted in the markets actually recovering, and India has been one of the strongest markets in the world in the year 2022 as the year ended. So when we look and think about how the markets are going to pan out over the next few years in the equity side, we are staring at a situation where the valuations of India are at record high compared to the world. The Indian valuations are not at record high compared to everything else on an absolute basis, but on comparing with any other part of the world today, they are at record high. And consequently, we believe that the outlook is likely to remain volatile for equities and making it very attractive for systematic investing in equities through SIP uh, and in systematic transfer plans or booster STP kind of investing plans over the course of the period. Of course, as you know, multi-asset investing and balanced advantage kind of categories are hybrid categories like equity and debt are other ways to actually invest at this point of time, given that gold and debt and REIT and various other asset classes also have a huge role to play in this stage of the investment cycle. That is the reason why we felt that it is very important to actually talk on debt as a asset class at this point of time. Why debt today? From 2008 onwards, the role of the market intermediary or the market referee has been taken over by the global central banks. And from 2008 till 2022 beginning, the global central banks actually kept on printing money. And I would say that there were three printing presses in the form of global central banks, one in US, one was in Europe, and the third was in Japan. 2022 saw the closure of two global central bank printing presses, both in Europe and in USA in 2022. And most people believe that in the year 2023, the global printing press, even in Japan, is likely to close down. What does this mean? What it meant was, when the central banks were printing money, like for example, the US Federal Reserve was printing money, any Indian corporate in India, all the top corporates in India could borrow globally at 0%. And they could borrow in dollar at 0%. So they said, why should I borrow in Indian debt market at 0%, at 7% or things like that? That has totally changed. So in 2023, when they need to borrow, they will have to pay an interest rate in dollar terms of maybe 5 to 6%. So which is totally different from 2008 to 2021. So which means that the entire environment has completely changed for the debt market, where every corporate in India can no longer borrow at zero rate in US in dollar terms. They have to pay 6% in dollar terms. Because they have to pay 6% in dollar terms, debt has become a very interesting asset class for Indians. Second, what has changed? I have the pleasure of working for ICICI Mutual Fund for 18 years. In 2004, to make a payment was difficult. In 2009 and 14 also it was difficult. But if you look at the period from 2019 to 2022, thanks to UPI, thanks to NPCI, thanks to digital, thanks to iProTouch, thanks to all these things, it is so easy to make a payment that today, if suppose I were to be in Indore on a day or Coimbatore on a day, and I have money in my bank account, it is so easy to invest in mutual funds because it is so easy. The payment mechanism has been made very, very easy in this country, thanks to the work done by all these institutions like NPCI at this point of time, that investing in a debt mutual fund has been made also very, very easy. Second, let's say I need money on Monday, and I am in Indore today or Coimbatore today. To just redeem also has been made very easy. That if I need money in a bank account on Monday morning, I can always redeem from a debt mutual fund and get money on a Monday morning very easily, and by just redeeming, because the entire telecom infrastructure and the internet infrastructure and infrastructure like iProTouch which exists has enabled very easy redemptions and allowed you to invest and disinvest in debt mutual funds very, very easily at this point of time. Was it possible in 2004? The answer is certainly no. But in 2022, the ease of debt mutual funds, both investing and disinvesting, has been made very, very easy from an investor point of view. What else has changed? Clearly, the interest rates have gone up. And Manish will talk much more about it. But today, the overnight interest rate has also itself gone up to 6% at this point of time. And everything is priced off the overnight interest rate. So every interest rate in the economy goes up, is in excess of 6%. So which means that investing in a debt mutual fund becomes very attractive because interest rates are not what it was 2 years back in December 2020 or December 2021. But in December 2022, interest rates have become 6% even on the overnight side. And that is the reason why you will find that all the products, even the low duration products like liquid and overnight, the yield to maturity of those products have become very, very much higher than what they were in the last 2 years, making all these products also very, very interesting. And over the last 15 years, what has happened is that the mutual fund industry, along with the support of regulator, has created many interesting categories like the all seasons bond fund, the ultra short bond fund, the medium term fund, the credit risk fund. And all these funds have a very, very interesting way of investing in debt with different time periods. You will be able to invest. So we have a situation where debt has become one of the most interesting asset classes for investing, and where the rate of interest that you can get will also be very different from what it was 2 years back or 1 year back. It's a very, very different environment, and the market is much, much bigger. As most of you know, the amount of money in equity mutual funds is about 15, 16 lakh crores. The amount of money in bank deposits is about 150 lakh crores. It's about 10 times the amount of money. And therefore, the return potential also has gone up substantially to 6% just on overnight. So it's a very interesting environment. And the reason for doing this call by ICICI Prudential is that we have a situation where there is a very interesting investment opportunity for a much larger part of your investment. Because when you invest in equity markets, there are risks at certain points of time. Whereas when you invest in an overnight fund or a liquid fund or those kind of products, the riskometers are also much, much lower, as most of you know, and it becomes very interesting. I will now hand it over to Manish, who will talk about everything in debt. He is our deputy CIO, has been with us for more than 15 years. So he has been running most of our debt funds, and I will now hand it over to Manish. Over to you, Manish.
Thank you, Naren, and a very good evening to all of you. Um, I'll just talk about the monetary policy because it's the recent event, and then I'll talk my broader view on the fixed income markets. As you all are aware that RBI has been hiking interest rates over the course of the last 6 to 8 months. And in the recent policy, RBI also hiked interest rates by 35 basis points. So it's now a very different environment of interest rates, and nobody believed last year or the year before last that we will soon see interest rate environment which will be so very different. So having a past experience of 3.25% of overnight rates and now shifting to almost 6.25 of repo rate, it's a big change. And in terms of the overall trajectory of interest rates, RBI is still right now looking at inflation. But my sense is that this RBI which we are looking at, it's a different RBI from where we have looked at in the past. If you remember the days of Urjit Patel, the RBI's rhetoric at that point of time was that they want to, pull back inflation to 4%. They were targeting it at 4%. This RBI is very different under Shaktikant Das, and the overall objective of RBI is also, in my mind, a little different, where they are okay with inflation being at 6%, but they're more concerned about overall economic growth. So their approach is different. Their timing was also different. Raghuram Rajan and Urjit Patel came in a time when the overall system balance sheets, the corporate balance sheet, the real estate, the banking balance sheets, they were under deep stress. Now that balance sheets are much more cleaner, the environment for RBI is also, and the environment for country is also very different. So therefore, RBI right now, from an approach of monetary policy, is following a more neutral approach, I would say. While they talk about, the overall target being 2 and 6 range, but in the broader perspective, they want inflation to be at around 6%. Now, at present, the inflation has been more than 6% on an average over the last 3 years, and in the over the last 6 months, it has exceeded 7% as well. So therefore, the near-term task for RBI is definitely to bring down inflation below 6%, which should happen over the course of the next 3 to 6 months, just because of the base effects. But if one looks at a little medium-term perspective, I think the medium-term inflation expectations in India has shifted from 4% to 6%. So, when somebody looks for his income wage at this point of time in terms of negotiation, he doesn't look at a 4% inflation now. He looks at a 6% inflation. So, therefore, what people expect is what is the outcome. So, therefore, in the medium term, I think that the inflation in India would be set around 6%. And this is an important point, because if you have to look at fixed income, you have to look at the lens of what you are getting in terms of returns over and above inflation. So when inflation was at around 4%, a return of 6.5% was great. A 7% return on a 10-year used to be very good. Right now, at around 6% of inflation, I think the short end of the curve, which is a 1-year CD, has moved to almost 7.5, 770. So effectively, if you invest in a 1-year certificate of deposit in a bank, you're going to get 7.70. However, if you invest in a 10-year bond, the return over there is around the same level, which is 7.5. If you invest in a 10-year GSEC, you will get somewhere around 730. So therefore, while at an inflation of 6%, a 1-year CD looks a great investment, but if you're investing in a long duration, possibly the returns are not as great, because you're not getting anything extra in terms of carry. In terms of RBI's overall outlook as well, they're kind of neutralizing policy now, which effectively means that in terms of rate hikes, possibly in my view, they will hike another 25 basis points and they will stop there. There are pressures, from global central banking, rate hikes, but I think that most we are past the peak in terms of anxiety in terms of global central banking rate hikes. So possibly RBI gets a window where he can hike another 25 basis points and stop. Now, one way to look at this is that since RBI has raised interest rates and they've stopped, one way to look at is, one, if RBI has stopped raising interest rates, you should go into very long maturity papers. This is what has happened in the past, 4 to 5 years, where whenever RBI has stopped hiking interest rates, if you invest in long maturity papers, you would have made good money. But I think this environment is different. In this environment, one, the inflation itself has shifted from 4 to 6%. So in RBI, if it stops at 6.5%, I don't see that in the next few quarters RBI is going to cut interest rates. Even though if Fed, if US economy, even if it goes to recession, US has to cut interest rates. I don't think that's the scenario which we have in India. So, the scenario which we have is a scenario where economic growth has moved up, credit growth after a long period of time has moved up, demand for money which was absent for, this long period of time, the demand of money has gone up in the system, both locally as well as because of external reasons. And because of this, the base requirement of deposits in the banking system is now very high. So if I have to plug all of this together, it effectively means that I don't see RBI in a rate cutting mode in the next, 1 or 2 years. So where should one look to invest at this point of time? The easy answer is the short duration assets are the best assets. Your 1-year CD, any which ways, is giving you 7.5, 770 kind of a rate. If you look to move beyond that in terms of credit, I think credit is a great asset class at this point of time. Given the fact that the economic shape and in terms of leverage, corporate leverage is very low. So credit cycle from that standpoint looks pretty good. And if the economy continues to have demand for money, I think the pricing of credit is also going to become more and more remunerative as we go ahead. So net in short, I think the short duration assets look great at this point of time. And for investors, after a long period of time, the last 2 years have been very dull. But fixed income has come back, as Naren has said, as an asset class. And in this neutral zone, which we have seen in the past as well, the returns for fixed income remains attractive for a long period of time, because you don't have this cyclical swings of rates going up and then suddenly rates going down. I think rates will remain high for a longer period of time, and therefore this asset class should remain a great asset class for investors. I'll stop here, and I'll give it to Amar for further questions.
Yes, thank you, Manish. And what I would request everyone that if you have any questions or queries, you put it in the chat box. In the meanwhile, I had few questions for Manish and Naren, and let me ask you, Manish. See, when it comes to equity investing, right, people look at a benchmark and where the indices is, and basis that actually take a decision. So there are people who wait it out, people who say at these levels I want to come in, at these levels I want to go out, and it's a simpler one. And when it comes to fixed income, typically 10 year is looked at as a benchmark, right? That at these levels of 10 year is where I want to come and lock my money into fixed income, and then ride the cycle, possibly also try to make some mark to market gains, because I believe rates will come down, and there'll be some capital appreciation. But what I heard is that the term premium that you call, right, the rate of 1 year versus the rate of 10 year is very very low. So how do I go about investing? The question that we typically face is that, should I put money today? 10 year, should I, it's at 7 quarter 730, should I wait it for it to go to 775? Do I wait for next rate hike? Do I stagger my investment? How do I go about investing into fixed income? Because what I heard from you is that rates are going to stay here for some time, and they are going to stay elevated. So you are going to keep on getting good coupon slash carry anyways, or the interest income is going to be higher. So that one answer, that how do I go about investing?
So, a very easy answer, Amar, is that you look at a fact sheet, we come up with a valuation model for fixed income, and if you follow that valuation model, we kind of, show in terms of, overall duration where the investors should be at different points of time. So clearly, in the current, framework, the valuation model is showing that we have to be in the low to moderate duration, not in a high duration. So it's a simple answer, but to make people understand what my point of view is that if you analyze the economy in terms of business cycles, there are cycles where economy is weak, it moves up in recovery, then it expands, then there's an excessive demand in the economy, it moves into the late cycle, and then there's a slowdown again. Now if you can analyze this part of the economy, the answer is very simple for you, where you need to invest. So, for example, when the economy was slow and into COVID, RBI cut interest rates aggressively. So, whosoever was invested in long duration before that made a lot of money. But when the economy recovers, generally the base interest rates are very low. Your YTMs are very low, right? And therefore, and liquidity is very easy. It's the most difficult point to generate returns out of fixed income. So over the last 2 years. Now, when the economy is into an expansion, RBI takes up the rates into a neutral zone, sucks out liquidity, and which is where the curve becomes very flat. So you remain at this point of time, because the curve is flat, there's no extra carry for you to build duration at this point of time. Interest rates are not excessive, I would say, they are neutral. So there's no point to take excessive duration risk at this point of time. You just have to earn carry, which is the phase we are in. Now, once this phase is over, this phase has high credit growth, high investment. Once this phase is over, we move to the late cycle. In the late cycle, there are excesses which gets developed in the economy in the form of high inflation, high wage growth. Typically, the situation which US is in right now. And in this period, the central bank over tightens interest rates, and which is a period where you have to add duration to your portfolio, because typically after this phase there is a slowdown, because the central bank wants to engineer a slowdown. Remember, in India in 2012-13, the central banks engineered a slowdown by taking the short term rates up to 10 and a half, and after that duration became one of the best strategies. So I think that strategy of duration you can only take when the rates in India are excessive, which I think if I have a 6% handle of inflation, I think more than 8% is what I will demand for 10 year to be in that part of a duration framework. In when 10 years between 7 and 8, I think there's no excessive duration risk which one needs to take in their portfolios.
So Manish, the way I hear it right now is that ignore that it's 725, because anyways I am saying, or you are saying, that look at the short end side, And if you have to look at the short range side, and if you select a product properly, then you can just put the money right away rather than trying to stagger it or time it for a 10-year to move at some point. Is that correct? Is my understanding correct?
Right. So my point is that it's a great, return profile for investors who are investing for a short period or for a long period, because the carry on the market has improved substantially. There were periods of time when, people used to get returns out of the duration framework when yields used to fall. We are not in that environment. In this environment, you have to look at the YTM of the portfolios, and which is where most of the returns will flow from. I remember a period of time in 2018 where people only concentrated on YTMs. Sadly, that was not the right period. But today, if you ask me, this is a period of time where portfolio YTMs have to be looked at. And while people look at the past returns to analyze returns, I think to analyze returns you have to look at YTMs. So while the past 1 year return may look suboptimal because interest rates have been rising, but just concentrate on YTM. I think most of the portfolio YTMs are in excess of 7% at this point of time for funds who have more than 1 year maturity. And clearly that should be, because 1 year CD, which is the base asset class itself, is at 7.5. So I think from that perspective, short duration funds, whether you want to invest up to 1 year, up to 3 years, anything between liquid fund to short duration, short term banking, PSU, CBF, all of these categories are great for investors. In this period of time, and of course, for investors who choose to have longer period of horizon, I think products like all seasons and credit risk fund are great funds to generate returns from fixed income.
So picking on that last line on all season bond fund, Naren, if I can bring you in over here, balance advantage fund and asset allocator fund is what at ICICI we created, envisaging that look, can we create something as a fund house where any investor for a longer term time horizon can just park the money and just let us do the rest. A little bit more about your thought on all seasons bond fund, and the importance that comes into this portfolio, into customers portfolio, and maybe Manish, after that, at least how we are managing and what the current strategy is on that. So over to you, Naren. Naren, you are on mute.
One of the learnings that you know I had the misfortune of seeing 2007, 8, 9, and the learning was it was a very unpleasant experience for investors in the mutual fund industry. Uh, Actually, the learning out of that actually was that debt is a great asset class, and if you look at it, if you had invested over that period for 3 years in debt, you would have had up. You could have used the money in debt to actually invest in equity, but somehow no one did it at that point of time because mutual funds never could easily be invested in debt. Today, debt has become a structural asset class because there is a first. I don't think Fed is going to open their printing press and start printing money. So, debt has become a structural asset class for the next few decades, in my opinion. So, that is one thing we have to keep in mind. The second thing we learned from 2007, 8, 9 was you have to create products where investors can invest every day and comfortably invest every day. I think it was on that basis that we actually launched the Balanced Advantage Fund or the Asset Allocator Fund of Fund. But if I compare it with equity fund, I would say that these three funds are more defensive than a equity fund, and I would say that these are three funds comparing themselves against an equity fund. You can actually tell people to look at investing any day, compare them with an equity fund. So the same thing, my colleague Rahul and Manish wanted to do the same thing in debt. And that product out of that same concept came All Seasons Bond Fund. And because they wanted to do the same thing what we tried to do in equity, which was that you invest every day in a product, and out of that, three products were there: Balanced Advantage, which invests in equity, debt, and arbitrage with equity taxation. If you look at all seasons asset allocator fund, which invests in equity, debt, and gold with debt taxation, and a multi-asset fund, which with equity taxation, which invests in equity, debt, REIT, InvIT. It invests in commodities, exchange traded commodity derivatives like gold, silver, crude, etc. So, with equity taxation, we said these three products are like that. So, we gave this job to Rahul and Manish to create a product like that in debt, where again, any day you can invest and not bother, should I invest in duration? Should I invest not in duration? Should I invest in accrual? Should I invest in floating rate? Should I not invest in floating rate? All those decisions have been taken care of by this product. Just like you have balanced advantage fund, asset allocator fund, and multi-asset fund, we have created this product. And I'll now hand it over to Manish because he can explain this product much better than I can.
So it's a, I think a unique experience of managing this product for now more than 8 years. And as Naren said, the genesis of this product was to give an experience to investors, which was much better, because most of the times what happens is investors tend to get into markets when markets are expensive, when most of the returns are already have come up in the past, and therefore investor experience is not great. And also for the reason that the debt taxation back in 2012, 13 or 14 changed from 1 year to 3 years. So we there was a requirement of a product which could which investors could invest for more than 3 years. But at the same time, the experience of the investors needed to be more than average. So what we did was, from the experience of Balance Advantage Fund, which is more of a process based product where we have a in-house process on which we run this fund, we thought we should have a product in fixed income as well, and which is where we started working on this. We tried to design our own in-house process for running this fund, and based on which we've run this fund for now more than 8 years. And the good part of this fund is that this fund has a lot of flexibility in terms of what it can do. It's a completely flexible fund in terms of taking duration risk. It can move from 1 year to 10 years duration. It has the flexibility to get into different asset classes, be it corporate bonds, GSEC, SDLs, floating rate bonds, fixed rate bonds, double A category. It can take all kinds of variety of asset classes. The idea was debt, from that perspective, gives opportunity at different points of time. Sometimes the opportunity lies in the duration as an asset class. Sometimes opportunity lies in short-end carry, which is high yielding opportunities. The fund therefore should have the ability to capture all kinds of periods in the market. Now the challenge is, if you have so much of flexibility and you provide that flexibility to a fund manager, there can be two scenarios. One scenario is you can have great experience. The other scenario is that, because large flexibility would mean large risk, there are imminent risk to run that strategy as well. But our experience has been, whenever you follow a process based approach, where you look at the right segments in the market in terms of historical valuations, and you invest with thought process that you have to look at segments where margins of safety are very high. And the good part is that if I'm an investor, if I want to invest for 5 years, 10 years, 20 years in the fixed income market, but I don't want to bother where do I put money in, I think it's a great solution for such investors.
Thanks, Manish. As I am talking to you and Naren, I was just refreshing the question. There are already some 143 different questions that has come, and of course, in the interest of time, and some of them you have, literally answered, but maybe a mix and match of something that I saw there and something that I wanted to ask you. Uh, Two things. There are two types of investors, and you can break your answer into two parts, right? There is a section and a segment who invest into credit risk as a category, medium duration bond fund of IPRO, etc., etc. And then there is also a section of investors who say, look, nothing doing, AAA and above, right? And of course, as a fund house, we cater to both these sides. So So very quick update on which you gave, but maybe on credit cycle and spreads and then credit risk fund in that side. And like Olsen Bond Fund, where are we on our AAA portfolio? Something like a short-term plan or a corporate bond fund or bank PSU in terms of the way we are managing this duration or the way we intend to play the current cycle, which you said is slightly longer. Naren said it's structural in nature at this point of time, where one can keep on investing and you can enjoy the higher carry for some time.
So clearly, if you look at credit growth, I think that's a good barometer to understand, whether you will get assets to buy. So I think we're still in that nascent journey of high credit growth in India. We haven't seen the private investment cycle still. And therefore, I think this journey will continue for some time. And the good part is that the corporate balance sheets in India are very deleveraged, which effectively means that if somebody wants to run credit risk at this point of time, the risk in terms of macros is very low. In terms of spreads, the spreads at this point of time in certain segments are still tight. But my view is that as we go ahead, as the credit demand picks up, deposit rates go up, some of these spreads will definitely become much better. So from that perspective, over the next 1 to 3 years, credit risk is a great segment for investors to be. As far as the AAA category is concerned, as far as short-term banking PSU or CBF corporate bond fund is concerned, the strategy which we've been following is very simple. As I said, there's no reason for us to take duration risk at this point of time unless we see valuations on the 10-year attractive to, I think that even that to trade. But otherwise, the idea is to build portfolios around 1 to 2 years and to get maximum carry on the portfolios. So our concentration is to get as much carry on the portfolios without sacrificing too much of duration risk. One of the strategies which we deployed this year was to invest in floating rate bonds, even in this category of funds, because the spreads on the floating rate bonds make them the best carry at this point of time in the market. If I have to compare, the carry of floating rate bonds versus some of the other segments in the market, floating rate bond carry right now is, as we speak, is at around 8%. Whereas if you look at the other GSEC segment, even 10-year trades at 730. So from that segment, just the concentration of carry makes us invest in some of these segments like floating rate bonds or 1 year CD in that segment, which I think is going to generate the maximum returns for the investors over the period of the next few quarters.
Thank you, Manish. One last question. Recently, and that's been for some few months, what is also getting popular is fixed income index funds, right? We have a 2027 series right now. We have 2030 series. We going to come out with 2026. But when I hear you, I hear that be on the short end side. So I would preempt and say that 26, 27, given the taxation for which you have to be for 3 years plus are the most attractive point. But your take on index fund and within index fund, am I right in analyzing that? Look, if this is the view, and I'm on the short end side of the curve, even when you buy index fund, be into 26, 27, perhaps 28, but not long end. Is that assumption correct?
I think this category of fund is a great product from mutual funds basket perspective. The reason is that one, investors understand what they're getting into. So from that perspective, uncertainty is very low. And given the framework of taxation, I think these products make a lot of sense compared to some of the traditional, avenues of investments. So clearly, I see this product category growing a lot. You're right that given that the short end of the curve looks more attractive, so being in the 26, 27 makes a lot more sense than being in absolutely long end like 2030, 2040, 2045. I still don't see value in that segment. But 2026, 25, 27, I think they are much better segments for investors to invest.
Uh, Naren, I'll move to some of the questions that I saw on the screen, and they are interesting. And this one, I would direct it to you. I've seen a question where somebody has written, "I have invested into equity savings fund for some time, and I bought it as a good, very near. No, I mean, I bought it as a good investment about a year back." Manish, a lot of questions and different people asking different. My time horizon is up to 3 months. Somebody asked asked my time horizon is, I want to invest for a year. Somebody has said, can I just invest for long term 3 years right now? So, how do you put the suitability of, a very shortened 1 to 3 months, then, up to 1 year, and then long term, which is in case of fixed income has better be 3 year plus from the, at least from the taxation perspective right now. So how would you put that, your kind of ideal product suite for that?
I think good thing which SEBI has done is it has classified product categories very clearly, and therefore it is very easy now to communicate to customers in terms of product categories and suitable to their investment horizon. Uh, Given that RBI has mostly raised interest rates and going ahead, there may be one or two more rate hikes. Very good products in that category. And as I said, if you look at the YTMs of all of these funds, you will appreciate how YTMs have changed over the last 1 year. All season bond fund, I don't need to time it. The good point is, if you ask me this question, last year, this year, the next year, I would continue to say that it is the product to invest for more than 3 years. So clearly, the entire return profile for fixed income has changed. So wherever you are, if you are an overnight investor, if you are a 3 month investor, if you are a 1 year investor, I think outlook of returns in fixed income has substantially improved. And therefore, you have a basket of products as is shown in the slide as well. You understand your investment, period of investment, and accordingly you can invest among all of these products.
I think one of the question is that what should I do? I have invested in floating rate fund, which Manish, I think you've answered that it is in very attractive space at this point of time, and I would on your behalf straight away say I think stay invested. Right? It's a good asset class. I think there are a lot of other questions that are there. Maybe just a very different googly Naren. Somebody has asked, and this I'm going to ask on a lighter note, though not strictly comparable. Is somebody has literally asked, should I switch my entire equity money to fixed income? Right, and I know that there is no right answer to that. However, I'm just going to still throw that googly on you.
No, no, these are all very difficult questions to answer. First of all, it depends on what that person wants, what is it that is being looked at, what is the need of the person, etc. What is the risk profiling of the person? There are no such perfect answers to such questions, and if you start giving such perfect answers, you are going to go wrong completely. And I believe that no one should ever give such perfect answers to such questions.
Absolutely, Naren. I think in the interest of time, what we will and to all our participants, thank you so much. But in the interest of time, what we will do is we will put out and map these questions and try to answer them separately. Broadly, we have tried to answer this in this entire framework of this call, right? And uh, we would of course, yeah, we would request you to contact to your respective relationship managers or respective contact points in ICICI Prudential. If you think anything is not addressed, we'll be very happy to separately address it one on one with you. Naren, Manish, any closing remarks before I end this call?
No, from my side, it's very clear. We would not have done this call 1 year back. We wouldn't have done this call 2 years back. Uh, the the whole global environment on debt has changed. We had the printing presses of the Western world, which supported debt in a negative way, and now we have a structural asset class in the form of debt, and consequently, we think that debt mutual funds are a wonderful way for investors to look at. They are lower risk than equity, and the potential for large investments is much higher in debt mutual funds. ICICI Prudential has created a lot of processes, and we have a long track record of people in this field. We have not talked much about credit risk, but we have spent a lot of time avoiding risk in the 2017 to 20 phase. And in that phase, there were risks, much bigger risks than what we are seeing at this point of time. But if we take the next 10 years, we will have all kinds of periods. But even in those periods, our goal would be that in all these products, Other than the credit trust fund, our goal would be to take only low risk kind of frameworks. And we have created processes and credit processes and duration processes on how to buy debt, etc. And we think there is a wide variety of products which investors should consider. The whole technology environment, the whole digital environment, the whole telecom environment supports investing in debt mutual funds. And I would say that has been a massive change which people have to understand. So those kind of things also people have hardly used in India. And I would say that those are things also which people have to think about. So debt is a great structural asset class for decades, which people have underused in the investing framework. And that's why we did this call today. Why did we not do it 2 years back? Because the global printing presses were on.
Manish?
Over to Manish.
So I think Naren, you've covered most of it. What I want to add over here is that mutual fund as a vehicle for investing in fixed income, it's a great vehicle. I have seen over a period of time that as an industry we have matured, and as a company, I think internally. I've seen over 15 years, there have been so much of changes which have been done that now I can talk to all of you more confidently in terms of what we do at ICICI Prudential, and I'm sure our experience is going to benefit you. Thank you so much.
Once again, thank you, Manish. Thank you, Naren. Uh, I will only close on that remark that, as Naren said, and maybe I'll repeat it, that we have the entire spectrum of product for every possible need, right? And right from a basic overnight fund, which is a great alternative to any lazy money that might be lying or excess money that might be lying, to a core investment of 3 year plus, and you should look at the 3 year plus when you look at some of these products on the fixed income side, because let them go through that cycle. The tax advantage at this point of time, as I talk to you, of course, for the long term capital gain, you have to be staying into fixed income fund for more than 3 years. So all the routes, all the products are there, and our team will be again very happy to assist you in any query that you may have, and we will look at these questions, and if we can link it and revert to you, we'll be very happy to revert to you from ICICI Prudential Mutual Fund. So thank you so much, everybody, and thank you, Manish. Thank you, Naren. Thank you very much. We can end the call, please.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.